And joining us now from Chicago via Skype video is Mr. Jim Hyercheck. He's the Chief Market Analyst for Brewer Investment Group. Good to see you again, Jim.
Hi, Don. How are you?
Very, very good. Now, we were talking about Forex, and I remember last week you were talking about the unemployment numbers that came out. They were actually worse than you anticipated. How did that affect the foreign currency exchange markets?
Well, this week, traders reacted by dumping on the dollar. They looked at the last week's numbers in this unemployment report, decided that the Fed's going to have to keep low interest rates here in the United States, and that put pressure on the dollar, pushing it down to new lows for the year. And traders started looking at the long side and higher risk assets such as Australian dollar, New Zealand dollar, and the euro dollar. So basically what it did is it pushed the dollar lower.
Well, now, we were just talking about what's going to happen with the dollar at the top of the program. So for people who are involved in foreign exchange currency trading, I mean, what's going on with the dollar? This is really groundbreaking stuff, isn't it?
Well, what's happening is the markets are looking at a weaker U.S. economy, and the Fed is already on record saying they're going to keep interest rates lower. So investors are looking for places where they can find higher yields, and that includes an area like in the Asian Pacific area of New Zealand and Australia. This week, the Australian Central Bank raised interest rates because their economy is improving, and they want to fight off inflation. And also, there's talk that they may raise again in December. So those currencies, the Australian dollar and New Zealand dollar, gained substantially on the U.S. dollar. And then in Europe, traders are looking at the Eurozone economy improving faster than the U.S. economy. And the European Central Bank has left rates alone at 1%. And so that, too, is also higher than the rates that they can get here in the U.S.
Well, now, Jim, of course, one of the things that's affecting the U.S. is that they're saddled with massive debt. Is that going to continue to affect the U.S. dollar amongst other world currencies?
Well, it's a long-term factor, and it's definitely going to have an effect on the U.S. dollar. We are funding this recovery, this global recovery, and saturating the market with dollars, and that's continuing to weaken our currency, coupled with Fed activity of keeping interest rates lower. Both of those are really pushing down the value of the dollar.
Now, Jim, I know I've asked this question from you before. Some folks may be seeing you the first time. When you're involved in foreign currency exchange trading, exactly what are you buying and selling?
What you're doing is you're trading pairs of currencies. Instead of buying an outright euro, you are buying the euro versus the U.S. dollar, or the British pound versus the U.S. dollar, or even you can pair the euro versus the Japanese yen. So you're looking for strength over weakness in a currency pair rather than trying to buy and sell both simultaneously.
Once again, we're talking about Forex, or foreign currency exchange. We're talking with Jim Hyercheck. He's the Chief Market Analyst for Brewer Investment Group. For more information, you can visit their website, brewerfuturesgroup.com. Jim, thanks for this week's update. We'll see you again next week.
Thank you, Don.
Take care.